Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is certified financial planner and registered investment advisor, Rob Odell. Hello everyone, I'm Steve Ssavant, syndicated financial columnist and talk show host. In this segment, we're talking about charitable giving of outright gifts like cash and appreciated assets, all from Rob's popular Mind Map seminar series. Well, I'm really interested. This week, we're going to be talking about charitable giving, and we're going to get deep in the weeds, detailed like we've never seen before. But let's kind of walk through the basic ones first. Outright gifts of cash. I think everybody at the end of this year, we're writing checks to our favorite charity, as long as they're IRS approved, they're nonprofits. We're all writing checks, and that's pretty straight up cash and so forth, appreciable assets.
Most people, when they give gifts to charity, it's usually checkbook philanthropy.
Right.
And what they need to know, most people, I'd say 99%, maybe 95%, give to public charities. That's your church, that's medical institutions, that's educational institutions. And what the law says is that they can deduct up to 50% of their adjusted gross income. That's the number at the bottom right of their 1040. So if they make $100,000, the maximum deduction they can take is $50,000, a gift of $50,000. Anything above that is carried forward into future years, and they can carry forward up to 5 years. Current plus 5, so 6 total years to use deductions.
Now, I know you live in this. How many clients actually give 50% of their AGI?
On some years they do.
Wow,
It depends on what their goals are, and that comes back into the planning. Now, if they give to a private foundation, the IRS reduces it down to 30% of adjusted gross income. But again, it's the public charities that get the majority of the gifts.
Okay. Now, I'm looking at the basics. I have a client. Most clients are some charitable benevolency involved in their life.
Right.
And so I know that going in, there's long-term planning for charitable giving. But let's say right now, besides writing a check, is there anything I can do before the end of this year?
Well, I mean, depending on the asset composition, but if you have clients who have low basis stocks or even really stocks, they should be looking at giving those instead of cash. Because if you give an appreciated asset, you get the same deduction, but you avoid the capital gain. And so, for instance, if you have a client who has a long-term capital gain property, meaning it's been held 12 months and 1 day, they can deduct a full fair market value. So if they bought it for $1 and it's worth $10, they get the $10 deduction, and they avoid the capital gain. If they have a short-term gain, less than 12 months, and they decide they want to give it to charity, they can only deduct the basis. So they bought a stock for $7, it's now $10, they give it to charity within 1 year, it's the $7 is the deduction. Now, the IRS says, even though you get the same deduction, is that they reduce how much you can apply against adjusted gross income. So if you give low basis stock to a public charity, instead of getting a 50% deduction, you get a 30. And if it's to a private foundation, instead of a 30% deduction, you get a 20. But you still get the 6 years to use it.
But if I'm looking at a normal person's portfolio, I'm been there more than 12 months in a day.
Most of them are.
All right. So let's just say, and I thank you for the caveat.
Right.
But I'm thinking, most clients, I'm thinking there, Steve, I cannot tell you how many times, Rob, when you first told me this, I was so surprised because most clients go, if I would have known that, I would have never written a check for cash.
Exactly. In fact, if you think about it as an advisor, if you get a tax return from a client, you can tell about that client's good part of their life. Are they charitably inclined? Because that's on Schedule A. You can tell how they give. Is it cash or is it in kind? Most people give cash. Then you can look and see if they have dividend income. If they have dividend income, maybe they have a mutual fund or stock, especially in the last 7 years, that has gone up in value. And if you as an advisor can say, give the stock and show them how to do it, specifically how to do it versus the cash, you'll be a hero to them.
Yeah, I'm thinking, why would I not give away a low base, low basic, I have all this capital gain tax. Why would I write myself a check, pay the tax when I could have given the stock all together and kept my cash flow?
Right. Well, in future shows, we'll show them how to do it and how you as an advisor can make it simple and explain to the client how they can do it. Now, one little caveat, charitable deductions are called below the line. I mean, they happen on Schedule A, so it's after adjusted gross income is computed. So it does not reduce adjusted gross income. Therefore, if they sell stock or have dividend income, it will not affect the 3.8% surtax, if you will, Obama tax, if they're high income earners, and will not but it will reduce taxable income. So you can move someone down a tax bracket by doing proper charitable planning.
Now, I think this is a huge thing you just said now. This could be worth a full step down in a tax bracket.
Absolutely.
That's a huge thing.
Maybe 2 brackets. You could take someone from the 33 and put them down to the 25, and then all of a sudden the marriage penalty goes away.
This is a huge thing that I think we're all trying to pay attention to in your audience. This is a huge bit of information.
Right. Let me give you a quick example before we close out the show. Here we have a couple in their 50s, $400,000 adjusted gross income. Earned income is $250,000. They have qualified dividends of $150,000 interest income. If they do nothing, no charitable planning, their federal tax liability is $95,000. Remember, $95,000 and change. Now, let's say they decide they want to get into philanthropy and they set up a private family foundation. The maximum cash deduction they could get for a gift of cash is $120,000. That will save them $40,000. So the net cost of that gift of cash to a private family foundation is somewhere around $80,000. If they give low basis stock, it goes down to $27,000 because they can deduct less. Now, most people give to public charities. Here we go. The maximum contribution that they can take, or the deduction they can take, is $200,000. The tax savings is $61,000. Whereas here, the public charity, it's $40,000 because it's 30% of adjusted gross income. So knowing the rules, what you're working with here, the net cost of giving to charity is really the $80,000 to give low basis stock to a public charity.
So let me redux. So if I'm doing a $95,000 check to the IRS, I'm now writing a check for $40,000.
$55,000. Because they're saving the $40,000.
Okay, so, but is my cash flow the same?
Cash flow is the same.
See, that's the art.
Right.
For more information on charitable giving out of outright gifts like cash appreciated assets, just click on the landing page address in the video description. We'll be right back with more from Rob O'Dell.
This is your website. Few people visit, and if it isn't attracting new visitors, it's not doing its job. Now you can drive more visitors to your website through dynamic content and email marketing with CreativeOne's Social Media Elite. Capture quality leads faster and easier. Engage your visitors with informative articles and videos to boost your online credibility. Plus, stay connected with existing clients and earn more referrals. All content is customized for you. It's time to introduce your website to the world. Call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, we're talking about charitable giving of outright gifts that are carry forward 5-year assets and charitable IRA rollovers, all from Rob's popular Mind Map seminar series. Well, I want to talk a little bit when we get into this, is just to make sure, because I don't want to get email on this, like Steve, I really don't think you spend enough time. 5-year carry forward. So once we cross a certain threshold on some of these ideas, right, we have a 5-year carry forward issue.
Correct. So let me give you an example. Let's focus on the public charity. Now we're going to dive deep in the next segment in the private family foundations, as well as public charities donor advised fund. But as we said in the last session, this couple, the recap, has $400,000 of adjusted gross income. If they give to a private family foundation cash, the maximum they can take deduction is $120,000. If they give a low basis asset, $80,000. These are the tax savings. This is how much less they write the check to the IRS for. If we focus in on the public charity, the maximum deduction they take is $200,000 if it's cash, $120,000 is charitable deduction. Now, questions that you will receive, I receive, is what happens if your clients make a major gift, like a $1 million gift? Let's say it's $1 million. Well, if it's $1 million gift, they can only use 120 of that. So what happens is the remaining, take 180,000, that would go into future years, the next 5 years.
So, but that would be amortized over a 60-month period.
60
right? Is that what I'm getting?
Yeah, it's over 5 years.
So if I cross over the 120,000 and I have $1 million, I have $880,000 divided by 5.
Correct. Now, chances are you're not going to be able to use all that deduction because you'll get out to year 7 or 6, depending on how you use the number line, and you'll have leftover deductions. So what do? Well, you create income, Roth IRAs, accelerate gain, cash out of maybe non-qualified annuity contracts. There's ways in which we can use that deduction.
Okay, so can I redux a bit? So if I know I have a big ticket item from a gift point of view, and I also have qualified money that I'd like to convert as well, and I'm going to have above more than I need to keep me in the same bracket or knock me down or even drive me to maybe a lot less than that, I could match up my conversion of qualified monies to Roths and cover that taxable event by doing this.
By eating up the charitable deductions, the carry forward, if you will.
Now, how much of this do you do in your practice like that?
I spend majority of my niche, if you will, doing this type of work, looking at a client's income taxes and integrating their charitable giving and their financial planning, as well as their estate planning.
This is a huge way to move people over to Roth. They got the deduction. We can now maybe cover some or most of the taxable event by converting to Roth, and we're still doing our benevolent giving at the end of the year. Wow.
Well, now let's talk about something that hasn't happened yet this year for 2015, though most people believe that Washington will get their act together, at least in this department, and bring this back for another year. It's called the Charitable IRA Rollover. This is for people over 70 and a half. who can give their required minimum distribution not to exceed $100,000 directly from their IRA to charity. It will not be picked up as income, so it's an above-the-line deduction.
Well, let's just go back the other way. And if they don't pick it up, we revert to the old law where the client is taking distributions from his IRA, which is a terribly inefficient way to do it,
right,
and then gifting that to the charity.
Yeah, then you'll get a Schedule A deduction. I've run the side-by-side comparison. Obviously, it's better to go directly to charity from the IRA, but it's not the end of the world because they were going to give this money anyways to charity.
Okay, hopefully Congress will get it together.
So what advisors should be doing right now is telling their clients that they should, if they're charitably inclined, is to give directly from their IRA to charity directly and hope the law passes. Remember 2012, they didn't pass this rule for 2012 until January 3rd of 2013. So they retrofitted back, and so hopefully they don't do that to us. But
now, is there any limit? And let's say you have a couple collects, maybe you have 2 or 3 IRAs collectively that are huge money. Do they really care how much you donate?
Well, the ceiling's $100,000.
Oh, so it is. There's a limitation.
They can only give $100,000.
Okay, but is that mom and dad in a married couple situation?
Per person.
Per person. So you could do $200K.
If they have that size, if they both have sizable IRAs.
Okay, now if we're at the end of the year, we could do 200 mom and dad on this side of the year and do another 200 in a about 3 weeks.
Right. Now, let me put one other caveat on here. It has to go directly to a charitable organization. It cannot go to a donor advised fund. It cannot go to a private foundation or a charitable remainder trust.
So I have to tell my custodian of my IRA I need check writing authority.
Correct. And get it done. And the institution, the charitable institution that is, needs to clear cash and clear that check before 12/31. So I have one client down in Fort Myers, Florida, and it seems like every year I'm saying, get your checks written, get them to the institution. Literally, last year, he was calling his charitable organization saying, please cash my check, which sounds crazy. You think they would cash immediately upon getting it.
Right.
Yeah.
You would think that. Now, so the limitation's $100,000 each. And again, if we're at the end of the year, you could play both sides of the fence if you want to really unload some serious money. This is a huge boon. We don't know what Congress is going to do. Hopefully, we won't have to revert back to the old taxation rates because that was very inefficient.
And if you have a client whose income consists primarily of their required minimum distribution, and if they give a piece of that away, you ought to see what happens to their income tax return. Because all of a sudden, the Social Security income that they have, they keep the majority of it, and they save tax on the Social Security.
Yeah, we keep thinking everything on the 1040 is correlated.
Yeah, exactly.
I mean, it just is. Well, listen, for more information on charitable giving and outright gifts and using the 5-year carry forward assets and even maybe charitable IRA rollovers, just click on the landing page address in the video description. And for more information on all our shows, seminars, workshops, just follow us on social media or visit us out on our website. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.